morning. I'm Andrew Topp with Investing News Network, and we're kicking off the 2014 Vancouver Resource Investment Conference with Frank Holmes, CEO of US Global Investors. Frank, thanks for joining me.
Good to be here.
So Frank, you're a big believer in investing in the right sectors. In your presentation, you mentioned that most investors are underweight resources right now. So what are you telling your investors about mining stocks at the moment?
Well, we've written and we published, we have my investor alert in the Frank Talk blog goes out to 40,000 people in 70 countries. So with that, what we've noticed on surveys and talking to people is that most generalist money managers in North America and in Europe are underweight resources. They've been net sellers, whereas resource commodity demand is actually starting to pick up because of Purchasing Manufacturers Index, PMI, globally has turned positive.
Right, okay. You've also commented on the potential for investors to capitalize on the US energy boom. So the shale and oil and gas revolution, as you know, is a game changer. So how can investors position themselves to take advantage of this sort of made in America energy renaissance right now?
Well, it's just the overall stock market's had a great boom for it. You're seeing it's a key factor, and one of the things that led to the stronger dollar has been the war in Iraq and soldiers moving away. The biggest buyer of oil in the world is the US military. And slowing down for war there basically improves the overall current account deficit. And then on the other hand, this shale discovery is allowing inexpensive oil and gas and natural gas to come into the American system. So I think that refineries are doing so well because they're so competitive. In Europe, they have to pay $12 for an MCF of gas. In the US, it's $4. You're also going to see in Canada all of a sudden to start to pick up many of the oil companies because the dollar's getting weaker. The Canadian US dollar, so that 10% decline gives a benefit to energy companies in Canada. And the price of natural gas going to $4, so there's that arbitrage. So I think that Canadian investors should be looking at Birchcliff as a stock we own, as a natural gas, well-run company.
Okay. How about Canadian oil producers, for example?
Well, you take a look at some of the paid oils and people like that, where you can actually get a dividend along with it.
Okay.
It's nice to get a dividend.
Absolutely, yeah. Okay, I was listening to an interview you did in November where you commented that gold is extremely oversold. So have we reached a bottom yet for gold?
Well, the sentiment is so pervasively negative, and I think that just based on the math of markets, it's down over 3 standard deviations. So we're due for a big rally. And year to date now, in 2014, gold stocks are up 12.5%. So you're seeing a great rally come out of the gold stocks. So I think that they're due for a big rally. I wrote about this piece of going back over 30 years of data. Only 3 times in 3 decades did you ever get gold stocks down for 3 years in a row. And then you had this massive move, like at the beginning of the great bull market in commodities in 2001, 2002, came off one of those depressed selling of gold stocks.
Right, okay. For most of last year, if you look at 2013, the gold market was really driven by the oscillations of the U.S. Federal Reserve, whether we're going to taper quantitative easing. So now they have come out and said that a taper has happened. Do you see the price evening out, or do you think it'll continue to slide as we keep talking about more and more reductions of QE?
Well, there's 2 key factors. Whenever you talk about gold, you have to appreciate there's 2 demand drivers. And I like to simplify it as the fear trade, which is all driven around the dollar and an imbalance between monetary and fiscal policy of the US government. The other one is the love trade. The love trade is more significant. It's 60% of the demand for gold. The run of gold to $1,900, a lot of that was the rising GDP per capita of China and India, affectionately known as Chindia, and Vietnam, and Cambodia, and Thailand, all these other countries along with the Middle East, rising oil prices, the recycling goes back into gold. So it's important to recognize what's happening on the GDP per capita for 40% of the world's population in Chindia. India, for the past 18 months, has been flat. They've been struggling with their economic growth on a per capita basis. So that has transformed into the demand for gold not as great as it's been before. 2 is the government's doing everything to try to stop the import of gold into India. So physical gold premiums are trading at $1,600 when gold is trading at $1,250.
Yeah.
So that's an important part in this whole equation. Now, I think that PMIs globally have turned positive. been positive for 6 months. That is usually very good for emerging markets. In the second half of this year, we'll start to show much stronger economic activity, and that will be very bullish for demand for gold, which is 60% is that love trade.
Yeah, okay, right. If you look at the whole gamut of commodities, not to be overly negative, but there isn't really one that isn't suffering right now. Do you have a favorite mineral or minerals that you're looking at in 2014 to do better?
I was mentioning that platinum and palladium look extremely compelling. Not only for jewelry demand, but the rise of cars and car sales. And we think that car sales will still remain strong in the US. And a big reason for that is that funding for borrowing to buy a car is so inexpensive. With the higher energy prices, the new cars are so much more fuel efficient. So basically you're getting people saying, I'll sell my clunker, and even though there's no tax benefit, I'm going to turn around and buy a more fuel efficient car, and that's very positive for platinum and palladium. The same thing for, if you look in Africa, the GDP without a leveraged economy is still growing at 5%, and you definitely need platinum and palladium for those different types of vehicles, if they're diesel or they're not diesel. And then you're looking at supply. Supply can easily be manipulated, or Russia, which is the biggest palladium supplier in the world, and South Africa is basically just been dysfunctional with union problems, poor government policy for electricity, etc. So you can easily have, based on that thought process, a slowdown in supply coming from the mines, which was only going to make commodity prices like platinum and palladium trade higher.
Yeah, okay. It's interesting in your comments on India, you're noting that India has 600 million people under 25. So obviously these young people are going to be wanting to buy fridges, cars, cell phones, and likely gold. But we're also hearing that the commodity super cycle is over. What are your thoughts on the global demand for commodities right now?
I think it's selective. I think you're going to have these cycles where a commodity A, B, and C will have great runs for 9 months to 18 months. I don't see them where they ran before for 5 years as a whole basket. That dimension has changed because the world's unemployment. There's still lots of spare capacity for hiring people and working. So if you go back to 2005, there wasn't much spare capacity, and therefore that easily drove up commodity demand, and commodity supply was restricted. We've gone through a big overbuild. We're having a contraction, especially in the gold space, that cutback, and that'll basically slow down the supply of new commodities coming on stream that were anticipated. We're going to see a shrinkage of that, except for fracking in the US. That is a different dimension. But most of the other hard metals, which this conference is predominantly speaking at, is metals, you're going to see supply get restricted. But the world's going to continue to have babies. They're going to continue, and that 7 billion is going to quickly increase because China changed their policy that you can now have 2 babies. So just think of 1.3 billion people, all of a sudden a new shift, and we believe the U.S. global government policies are a precursor to change.
Okay. We're often told to be a contrarian in bear markets. That's cold comfort, though, to people who bought stock last year, let's say, when we were in a pretty serious bear market. So when do you think markets will pick up? What's your view? Well,
you have different asset classes that you have to think of: big cap, mid cap, small cap.
Yeah.
The big cap stocks had a great run last year, predominantly because they paid dividends. They had cash flow, and they can stop their exploration or development and conserve that cash flow for paying dividends. They're the stocks that had the best performance overall. The junior space, they didn't have a huge footprint of 3 million ounces of gold at more than 8 grams and it being a takeover candidate. They basically wavered. And there's been very few big discoveries to justify capital going into a lot of these juniors. And there's been no technology breakthrough for these juniors to be able to unleash big deposits at a lower economic price. And that has been a big impact. It's because the commodity price, the cost, the regulatory cost for forming capital in the public market has become exceedingly overbearingly expensive in Canada. 2, the environmental cost for developing any project, bring it on stream on time, has gone up dramatically. So these smaller companies are basically being forced out unless they have a big discovery, big deposit, and they're bought out. So is Cisco. Cisco's a stock that made some of the gold funds here the best in 2011, had spectacular performance, stock went to $23. and it went down to 3, and now it's taken over at 6, basically.
Yeah.
So you're seeing that Goldcorp is going to do that because it's a creative transaction. It's already gone through all the environmental hurdles. It's gone through all the teething issues it's had to deal with. And it's basically trading for us on a valuation per gram of gold. It's in line. So we owned it. We started buying it last summer. And that was the first time we really took a big position. It was in our top 10 holdings. So we like stocks like that, and that's what we're trying to fine tune to go through that universe. And the bigger companies aren't going to buy that junior explorer unless there's a footprint of the sheer size close to a mill already built. Because the environmental delays and disappointments in the capital markets are too great to raise capital.
Yeah.
So you therefore have to be very selective.
Okay. Yeah, you mentioned, I mean, you can say one of the worst hit gold sectors has been gold equities. You wrote in a recent article, now may not be a good time for investors to ditch gold stocks. So why not? Why should people hold on to their gold stocks?
I've always advocated a 10% weighting. Always. And I've always thought it's prudent. And in fact, for the more conservative investor, I've said 5% bullion and 5% gold stocks and rebalance each year. Going back to the 80s, there were studies done by professors at Wharton, been updated by other scholars that have done this sort of asset allocation, owning gold and rebalancing, and you catch this volatility. So I'm a big believer that if you've been long the stock market and you've enjoyed this wonderful run, it's just prudent. Take some profits and buy gold. It's depressed.
Good advice. Okay, I think let's wrap it up there. So it's been great speaking with you, Frank. I've been talking with Frank Holmes, CEO of US Global Investors. I'm Andrew Topp from Investing News Network. Thanks for joining me.